Good evening, my host.
Good evening, sir. I can go ahead, sir.
All right, sir. Good evening, everyone. I'm welcoming you to our usual SFM class on this platform. Without wasting our time, week 3 is already going to an end. Gradually, after tomorrow, we'll be left with just 1 week, and that remaining week should be for edging. So I will try as much as possible to cover portfolio theory today and option pricing theory tomorrow, so that we can go fully to our edging next week. Okay, so without wasting much of our time, we already know the rules of this class. Okay, I believe all of us here have one time or the other joined this class. So okay, so we already know the rules and regulations guiding the conduct of the class, so I wouldn't waste time going through those rules again. So I'll go straight to where we stop in our last discussion. In our last class, I think we solved this question on economic value added. I think that was our last question on Tuesday. Okay, economic value added, and I will implore you, please go through the principle I highlighted here for economic value added, because economic value added was last tested in 2016 May. Okay, so it's been very long that ICANN tested the economic value added. So it's a flashlight to us that this time around they might decide to go in the way of economic value added. So make sure you understand the principle. The principle is quite simple. What we just need to do is to sit down and reason alongside what we have done on this platform. I told you basically we have 6 adjustments in economic value added, and that topic is one-way traffic. Once you understand these 6 adjustments, then I can bet you sincerely that you can do a economic value added question at least with 80% accuracy. So don't joke with that topic, please. Okay, having said that, I go straight to the question of the day. Question number 2. Yeah, question number 2. Now let's read the question and we provide solution to it. Okay. Consider a client having a portfolio of 3 stocks. Consider a client having a portfolio of 3 stocks. The various expectations and the current market situations are tabulated below, all annualized values. Okay, the current risk-free interest rate is 6% per annum. Now we have our stock. Look at it. We have 3 stocks: stock A, stock B, stock C. Stock A, stock B, stock C. These are the expected returns. These are the expected returns. These are the standard deviation. These are the standard deviation. These are the beta. These are the beta of those securities. Okay. Now, A, calculate the required return from the 3 stocks if they are correctly priced in accordance with the capital asset pricing model, CAPM. Okay. B, are there any discrepancies between the return based on the CAPM theory and your own expectations? If yes, advise on how to reshuffle the portfolio within these 3 stocks in order to profit from them. If no, explain why. Okay, before we solve the question, let me provide a framework to portfolio as a topic. Now, by portfolio, we mean collection of investment. Okay. Anyway, portfolio can mean different things. in different profession. When we are talking of politics, for instance, where it's a portfolio, we are talking of position. Okay, what is the portfolio? Your position. What are the various functions that we are expected to perform? Okay, that is the portfolio of your what? That is your portfolio of your position. So we can say the portfolio of the president, meaning that what are the various functions expected to be performed by the president. Okay, now in relation to financial management, whenever you hear portfolio, portfolio is a collection of various investments in what? In one. Okay, collection of various investments as what? As one is what we call portfolio. For instance, I may have investment in Zenith Bank. I may have investment in MTN. I may have investment in in an oil and gas company. Okay, now the collection of this investment represent my portfolio as an investor. I believe that is clear. That is what we call portfolio. Now, what about portfolio theory? Portfolio theory is explaining how you can manage your portfolio in order to derive maximum benefit from that portfolio. That is what we call portfolio theory. You agree with me that every investment has its own associated risk, isn't it? Every investment has its own associated risk. And because as an investor, your aim is to derive a maximum benefit on your investment. Now, what you tend to do is that you try to look for investment opportunity that when combined as a portfolio gives you the maximum benefit that you require. Okay, that is what we call portfolio theory. Okay, that's what we call portfolio theory. Now, and the risk attached to each investment is measured by what we call the standard deviation of that investment. What is standard deviation? We have been doing standard deviation right from our SS1, when we're doing a measure of dispersion. If you can remember, in our SS1, we all did a measure of dispersion, where you discuss mean deviation, standard deviation. Okay, that standard deviation is what we are discussing here on this platform this evening. Now, when we say standard deviation, we are talking of how our expected return tend to deviate from our required return. What do we mean by expected return? And what do we mean by required return? The required return on investment is your own desire. The investors desires what? Desired outcome of that portfolio. That is required return. However, the return on that the portfolio that should be expected may sometimes be different from what? From the required return. Hence, there is tendency that the expected return will deviate from what? From the required return. That deviation is what we call the standard deviation of that particular the return of that particular investment. Are we together? Okay, that is what I'm trying to say in a nutshell is that whenever a question tells you to compute the risk of an investment, what the question is telling you is to compute what? Is to compute the standard deviation of that investment. Okay, the standard deviation of that investment. Okay, that's about that. And then what about standard deviation of a portfolio? The standard deviation of a portfolio is measured, the risk of the portfolio is measured by the standard deviation of the portfolio as a whole. Okay, by the standard deviation of the portfolio as a whole. You know, I said the risk of an investment is what? The standard deviation of that particular investment. For instance, in this question, we have investment A, investment B, investment C, isn't it? Now, the standard deviation you are seeing here, this 35%, how risky is stock A to buy? While the 20% standard deviation here is the riskiness of stock B for any investor that may want to what? Invest in that particular stock. But when we are not talking of the portfolio as a whole, we are talking of the risk attached to the portfolio, and it is measured by what? By the standard deviation of that portfolio as a whole. Now, how do we measure required return? I've explained various components of the portfolio now. Okay. Now, how do we measure the what do you call it? How do we measure required return? Yes. How do we measure required return? How do we measure expected return? How do we measure standard deviation? And how do we measure beta? Okay. Now, to measure required return, your required return is measured using your normal CAPM formula that you know. We have been using the CAPM formula for long. Cost of equity is equal to risk-free rate plus beta of equity, market return minus risk-free rate, isn't it? If you want to measure required, that return we compute from the CAPM is what we call the required return. Okay? It therefore means that for you to compute required return, you make use of what? The CAPM formula. Anywhere, anytime you hear required return, you make use of what? You compute it based on the CAPM formula. I believe that is clear. Okay. What about expected return? For expected return is measured as probability into bracket x minus x bar square all over what? All over, all in what? In square roots. Okay, summation of probability into bracket x minus x bar close bracket square all square roots. That is what? That is how our standard deviation is measured. Meaning that if I want to get standard deviation, what will I do? I will start with my required return. Okay, this one is expected return here, please. Assume this required return. I will start with my required return. I will put my probability. I will multiply the probability by the expected return. Okay, probability by the required return will give me the expected return. Then I will sum up the total expected required return. My required return is what is represented by what? By x. While my expected return is what is expected by what? X bar, meaning me. Okay, the me. Okay, you have been measured. You know how to measure me. That expected return is likely to your what? Your me. Okay, so deduct expected return from required return, then square it. Do it for each of the return square roots. Okay, that is your standard deviation of that investment. And that is the riskiness of that particular investment. Have we taken down the formula? Okay. Now, what about the standard deviation of the portfolio as a whole? And before I go to that, let us compute. What about if the question tells you to compute the okay, I've already explained that anyway. Expected return from an asset is what? Is the required return times what? Times the probability. That will give you the expected return from that particular word, from that particular investment, for that particular stock. I'll be using stock here. Okay. Whereas when they say expected return, okay, expected return from a portfolio, expected return from a portfolio is computed using what we call what is popularly known as the snake formula. Okay, as the snake formula. Let me quickly see the snake formula and show you before we continue. the snake formula. I want to show you the snake formula. Okay. Now, this is what we call the snake formula. Can you see it? This is what we call the snake formula here. This is what we call the snake formula. If you want to compute the riskiness of a portfolio, then you make use of what we call the snake formula. It's given as it's called the name snake because of what? Because of the length of the formula, okay? Because it's lengthy. That is why a student name it as what? The snake formula. It's not named in financial management, okay? The snake formula, no, it was named as the snake formula among the students, and because of what? Because of the length of the formula. Now, the expected, the standard deviation of what? Of a portfolio is given as what? The standard deviation of investment Y or stock Y square times the weight of that investment plus standard deviation of Z square, which is the second stock now, times the weight of the what? The second stock square plus 2 times the weight of Y times the weight of what? The weight of Z. Then multiplied by covariance YZ. We are going to explain that formula when we come to that particular question. Okay. So that's how to measure that. That's what you need to use when measuring the standard deviation, the riskiness of a portfolio. Now, if you want to measure the expected return of a portfolio, the expected return of a portfolio is measured by getting the proportion of your investment that you have invested in each of the stock, then multiply by what? By the required return on each of those stock. That is when we aggregate the result, what we get is the expected return on that portfolio. Are we together? Okay. And beta is measured as the standard deviation of the market. Sorry, the standard deviation of the stock over the standard deviation of the market. We're going to see all this formula as we progress. Okay. Now, this question asks us to calculate what? The required return. The required return from where? From the 3 stocks, if they are correctly priced in accordance with the capital asset pricing model. Okay. And I told you, even though it is glaring from this question, even though the question did not tell you, to compute required return, you make use of what? You make use of the CAPM formula. Therefore, if I want to use the CAPM formula, these are my beta. These are my beta. I will say my, got it? Return on the stock or the investment is given as risk-free rate plus beta. What happened here? Yes, Mr. Ume Joy, okay, Ume Joy. Expected return is different from required return. I think I've explained the difference. I said that when you say required return, is the investor's desire, okay? Is the investor desired return on that particular stock, okay? But when we say expected return, it is the return that is expected based on what? Past performance of that particular stock. So it might not necessarily align with what? With the required return of the investment of the investor. Are we together? So required return is the investor's whole desire return on that stock, while expected return is based on what? Probability of performance of that stock. Are we together? That is the difference between required return and expected return. So the two are quite different from each other. Okay, so you are going to see as we progress, don't worry. Now, this is the formula for my required return, isn't it? That's the formula for my required return. So I will go and compute for each of the assets. Look at it. This is the beta of this security A. This is the risk-free rate, And this is what, look at it. We have market index here. What can you see here? Market index. This is what? This is the market return. You can see it, 12%. That is the market index given to you. The return on the market is what? You can see on out together. So that's what we're going to pick. Just come here, straightforward. It's not difficult. If you understand the principle of portfolio theory, it's where you can get your very cheap mark and you go. And it's not complex if you understand it. It's not complex. It won't waste your time at all. Okay, I will say required return on stock A. Required return on stock A is the risk-free rate plus beta of that particular stock, which is 1.36, market return minus risk-free rate. When I evaluate this, my required return is what? Is 14.2%. Do the same thing for stock B, 6%. Do the same thing for C. Look at it, you get 10.1%. You are done with what? With requirement A. Isn't that simple? It's simple. It's simple. Okay, that's simple. All right. Let me also tell you that sometimes the question will not give you this beta. Are we together? The beta may be hidden. The examiner will just hide the beta. They will not give you the beta. And they ask you to calculate required return. And you cannot calculate your required return without your beta. Okay? You can't calculate your required return without your beta. So what do? You can compute your beta using the standard deviation of what? Of the stock over the standard deviation of the market. So I will simply say my beta over what? Over 23. 35 over 23. 35 over 23. Okay? That's going to be giving me a what? My beta. Okay? That is when the beta is not given to you. That is how you should compute your beta. Okay. Now we are done with A. What is B saying? B is saying, are there any discrepancies between the return based on the CAPM theory and your own expectations? Okay. If yes, advise on how to reshuffle the portfolio within these three stocks in order to profit from them. If no, explain why. What the question is saying is that the return you have computed based on CAPM, is it different from the expected return on this stock? That's what the question is saying. Yeah, it is not. Okay, Mr. Adam. Now, it might not be the same. Let me tell you the reason why it's not giving you the same. Normally, if you have a correlation, okay? If you have correlation in the question, I want to compute the beta. I want together. If you have correlation in the question, I want to compute the beta. Beta is computed as standard deviation of the investment times the correlation coefficient all over the market standard deviation. Do you understand? So perhaps the question must have been set based on that. Okay, they must have used this standard deviation to multiply the correlation before dividing by what? 20. Do you understand? So that may be the reason why they are not giving you the same result. So the number is what? Your beta can be computed. Okay, let me Please, sorry about the disconnection, please. Now, I was explaining various way of computing beta, isn't it? I said number one, it could be computed as what? As standard deviation of the stock all over standard deviation of the market. That is one way. The second way, it can be if the examiner gives you variance, they can give, don't forget, your standard deviation is square root of variance, isn't it? Standard deviation is square root of variance. So if what the examiner gives you is variance, just say the variance of the stock over variance of the market. Do you understand? Over variance of the market. Okay. The third one is that they can give you standard deviation or variance in addition with what? In addition with your correlation. In that case, you cannot ignore the correlation. You have to do standard deviation of the investment multiplied by the correlation coefficient all over market standard deviation. And if it is variance, it's going to be variance of the stock multiplied by the correlation coefficient all over what? All over the market variance. Do you understand now? So that's the reason why we are not having the same thing here. Okay, that's the reason why we are not having the same thing there. Okay, let us continue. Now, B is telling us that we should identify whether there is difference between the expected return and what? And the required return. The expected return and the required return. Now, what do you do? Our expected return is already given here. Look at our expected return. These are our expected return. And we have computed our what? We have computed our required return. So you go and compare the expected return with the required return. Now, the difference between the expected return and the required return is what we call the alpha value. Okay? The difference between what? Expected, not other way around, please. You cannot do, if you do required return minus expected return, you will come up with what? With a wrong conclusion. So it must be expected return minus required return. Okay? Expected return minus required return. Now, the expected return and required return, the difference is what gives us what we call the alpha value. Okay? Meaning that alpha measures the difference between the return expected on that stock and what? And the required return based on the CAPM formula. And it is used by stock analysts to advise their clients, okay, on what stock to buy and what stock to sell, okay? If you go to the stock market, this is what they use. They use alpha value to see, oh, those people that are trading, okay, that are trading on stock, those that are trading on the floor of the stock exchange, this is what they use to make decision as to which security should be bought and which one should be sold. That is alpha value. Now, look at this now. Look at our expected return on stock A and look at the required return. What is happening? You see that the difference is negative. Please, the sign of the difference is very, very important, okay? Because it will determine the decision you are going to make, okay? Look at the expected return on B and look at the required return. What's happening? We have a 0.3 positive. Look at the expected return on C and look at the required return. What's happening? Negative 0.1. Okay, it means there is what? There is difference between the expected and what? And required return. Now the question is now telling you, if there is difference, then advise your client on how to reshuffle the portfolio. How does he reshuffle the portfolio in order to profit from that what? From the trading stocks. Now, this is how you are going to advise your client. We have stock A, B, and C. Now, for stock A, our alpha value is what? Is negative, isn't it? Alpha value is negative. For B, alpha value is positive. For C, alpha value is negative. What is the implication? The implication is that when your alpha value is negative, it means that the stock is overvalued. Okay, the stock does not worth the amount it is being sold on the floor of the exchange. Okay, and because that stock is overvalued, if you are holding that particular stock, then you quickly sell it, because by selling it, you'll be able to make what we call abnormal return. You'll be able to make abnormal return. Okay, because it means the stock is not correctly priced. Okay, it's not correctly priced. Okay, let me continue. I'll explain that. Don't worry. Now, look at the next one, which is what stock B. Alpha value is what? Alpha value is positive. What does that mean? It means the stock is undervalued. Yes, Mr. Marcos, I'm coming there. Don't worry. That's why I said, let me complete this before I give you that. Now, alpha is positive. When alpha value is positive, the interpretation is that the stock is what? Is undervalued. And if the stock is undervalued, what should be your strategy? Your strategy is that you buy more of that stock. You buy more, because it means the value as stated on the stock exchange is what? Is actually more than that. So what do? You buy, because there is every tendency that the stock price will shoot up. Are we together? Now, that is, you buy. You can see that. So alpha value negative, sell. Alpha value positive, we do what? Do buy. You don't need to cram this. You don't need to cram this. Whenever you have minus, what does it mean? It means you are giving out. Abi? Just take it that way. When you have negative figure, what does it mean? It means something is going out from you. Abi? You are selling that stock out. So take it that way. You are selling the stock out. Negative is going out. But when it is stock positive, what does it mean? You are collecting an item. Okay, so you are buying. Are we together? Now back to your question, Mr. Marcos. When the alpha value is 0, when the alpha value is 0, it means that the stock is correctly priced. When you do your expected return minus your required return, and what you have is 0, it means the stock is what? Is priced correctly, okay, on what we call the security market line. Okay, we have what we call the security market line. Time will not permit us to go into detail of those things. Okay, time will not permit us. Now, on the security market lines, we have some stock that will lie on the line. Okay, the line is a positively sloped graph. It's a positively sloped graph on which we use to determine assets that are what? That are correctly priced, overpriced, or what? Or underpriced. If you draw the security market line, okay, if you draw the security market line, when you plot the graph, any asset, any stock, okay, that lie on that line, okay, any stock that lies on that line, it means the stock is correctly priced. Is correctly priced. What is the implication? It means the implication is that the analyst, okay, the stock analyst cannot make any profit by studying the market, by buying that particular what? By buying that particular stock, because it's already correctly priced. Now, an asset or an investment or a stock with alpha value of 0 is found where you have a strong form efficient, in a strong form efficient market. Okay, in a strong form efficient market. Please take note of what I'm saying here. They will definitely help you. Okay, they will definitely help you, because the question can tell you in which market. Okay, they say explain the alpha when alpha value is 0, and indicate in which market will such a stock be trading? In which stock can you find such a stock? Are we together? So when alpha value is 0, it means the stock is what? Is correctly priced. You cannot make profit by trying to what? To manipulate the stock by maybe buying more or selling. You'll be indifferent to whether you are selling or you are buying that stock. Are we together? Now, and I told you where you can find the market where you can find such stock is in the strong form efficient market. In the strong form efficient market. Okay, that is that about question number 1. That is that about question number 1. Any question on 1 before we proceed? Okay, question number 2 rather. Do you have any question before we proceed, please? I will give you just 1 minute to ask your question. I must finish this topic today. I must finish it today because our last day for option is going to be tomorrow. Throughout next week, we'll be discussing hedging. We'll be discussing hedging. So we don't really have much time. So any question? Any question on what I've done in question 2? Any question, please? I'm waiting for your question in the next 1 minute. When it is 7:39, I will go straight to question number 3. Can you have a situation where you are asked to compute the correlation? Yes, yes, you can have it. You can have it. Don't worry, we are coming there. The next question we address that, okay? The next question we address that. How to compute correlation, okay? The next question we address that. Non-strong form of strong form, 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 strong form efficient. We have 3 types of markets. We have the weak form, we have the semi-strong form, and we have the strong form efficient market. Okay, so it's form, not font. Strong form efficient. Okay, let us go to question number 3. Let us go to question number 3. Now, question number 3 says, Abayomi has 1,100 fully diversified portfolio. He subsequently inherit FCA company stock worth 1,400 naira. His financial advisor provided him with the forecast information given as follows. We have expected monthly returns. We have expected standard deviation. Then we have our original portfolio. The return, expected monthly return on our original portfolio is 0.67%. Okay. The standard deviation of our original portfolio for Abayomi is 2.37. The FCA company, the return on the investment in that company is 1.25% per month, while the standard deviation is 2.95%. The expected correlation of FCA stock return with the original portfolio return is 0.4. The inheritance changes his overall portfolio, and he is considering whether or not to keep the FCA stock. Assume that Abayomi keeps the FCA stock. Calculate Roman figure 1, expected return of his new portfolio. 2, expected covariance of FCA return with the original portfolio. 3, expected standard deviation of his new portfolio that include the FCA stock. Now, if Abayomi sells the FCA stock, he will invest the proceeds in risk-free government security, yielding 0.34% monthly. Assume that Abayomi sells the FCA stock and replaces it with government security. B, calculate Roman figure 1, expected return of his new portfolio that include the government securities. 2, expected covariance of the government security returns with the original portfolio returns. And 3, expected standard deviation of his new portfolio that include the government security. And C, determine whether the beta of his new portfolio that include the government security will be higher or lower than the beta of our original portfolio. Justify your answer with one reason. No calculation is required. Now, this is a simple but technical question. It is a simple but technical question. Okay, let us solve the question one by one. The requirement A, Roman figure 1, say we should calculate expected return of his new portfolio. This is the original portfolio. Look at it. This is the return on what? On the expected monthly return on the original portfolio. Okay. Now, Abayomi is inheriting what? The FCA stock. And what is the value of the FCA stock? 1,400. Abi? 1,400. And what is what? The value of Abayomi's current portfolio. 1,100 is the value of Abayomi's current portfolio. So the first thing I'm going to do, if I want to, you know, we are going to have new portfolio, Nabi, because this is the original. We are adding new stock to it. We are adding new stock to the existing portfolio. So we are going to get a new portfolio, different from our existing portfolio. Okay. For me to now get the expected return of my new portfolio, what I will do is that I will have to look for of my original portfolio with the total portfolio, including the new stock. And what is the proportion of the new stock to what? To the total portfolio, including that same new stock. That is what, that will give me the weight, okay? That is what we call the weight of the investment in the portfolio. So the first thing I'm going to do here is that, look at it, I will say, I will calculate the total, okay? Look at it. Total amount of fund in the portfolio is what? 1,100, which is that original or new? Okay. Over what? 1,400. Which one is the new? Let me check. Okay. Original is 1,100. So new is 1,400. Now look at it. This means that in the portfolio, the weight of my original portfolio is 0.44 compared to the total portfolio. The weight is same as the proportion, okay? The weight I'm talking about here is the same thing as the proportion of the investment, of the value of the investment in the portfolio. Now, what about the other portfolio, the other stock, which is the FCA stock? For you to get that, just say 1 minus what? Is 0.44. We give you the weight of the FCA stock to the total portfolio. Okay. Now, if you now want to calculate the expected return on the new portfolio, is going to be the return on original portfolio multiplied by the weight, okay, of the original portfolio. Okay. Now, the weight is what I indicated. Sorry, W should be here, but you can equally use X. There's no problem. You can just change this W to what? You can change that W to X because I'm using X here as my weight. You understand? So that X you are seeing here is what is representing my is 0.44. This is RY, my return on the return on my original portfolio. I multiply by the what? By the weight of the original portfolio with respect to what? With respect to the total portfolio. Now, I will now say plus the return on the FCA stock, that is Z, okay, multiplied by the weight of the FCA stock in the portfolio. That is 1,400 over what? Over the total, over 2,500. Or you simply say 1 minus 1 is 0.44. You can say my X represents 0.44. That's why I simply put it as what? 1 minus X, which is as 1 minus 0.44. So I will say my expected return on the portfolio is 0.67 times the weight of the original portfolio, which is 0.44, then plus the return on the FCA stock multiplied by the weight of the FCA stock. Can you see that? That is how you compute your expected return on the portfolio. It follows the same principle you know under your expected return. The same principle. There is no difference at all. Now, I will now say 0.2948 plus 0.7 if you evaluate that. So I will have what? 0.995. Or we can say 0.1% approximately. Is 0. What? 0. Oh, sorry, 1%. I meant to say 1%. Approximately 1% is the return on that portfolio. Okay. Sorry, look at this. Please adjust this. It's not supposed to be expected return. Okay. This is not supposed to be expected return. It's supposed to be required return. Okay. This is supposed to be required return. Required monthly return. Please change that to required. Because what was just computed now so is the expected return. Thank you. Okay, Rennie, which one did you get? The expected return or what? Do you mean the expected return? Okay. Okay. Now, if you want to get your expected value, forget about this question for now. If you want to get your expected value, how do we compute expected value? The value of that particular item, whose expected value you want to get, multiply by what? Multiply by the probability. Abi, I will say return times probability. If I give you return on an asset and they tell you to compute the expected return on that asset, what do? You just multiply the return on that asset by the associated probability, isn't it? How do you compute that probability? Don't forget, probability must be sum up to what? To 1, Abi? Probability must sum up to 1. If that is the case, that same principle is what I'm using to compute my expected return here. Now, look at I've told you that you should change this one to what? To required return, Abi? Change it to required return. Okay, I will say, this is my required return on this what? On my original portfolio. Okay, what is the weight? What is the proportion? What is the probability of that return? The probability is not going to depend on the amount I invested on that what? On that particular portfolio. So, for you to get that probability, you will add 1,100 to what? To 1,400. These are the two items we have in the portfolio, Nabi. Now, for me to now get the proportion of my fund, the proportion of my fund that I have invested on this portfolio is going to be this 1,100 all over the total. This plus this is 2,500. I will say 1,100 all over 2,500. That will give me my weight, or what we call the proportion, or what is likely to what probability. So I will use that one to multiply this. That is the expected return on that original portfolio. Now, I will take this one also. I divide it by 2,500. I use it to multiply this. I will get my expected return on the FCA company stock. Then, when I add the two expected return, I get the expected return on the portfolio. That is the simple thing I have done down there. That's the simple thing I have done down there. Okay? That's what I indicated in this formula. Expected return on portfolio is equal to required return on Y. You got it? Okay, thank you. Thank you. Let us go further then, if you have gotten it. My host, please can you confirm the status of my network? Hello, my host. Can you confirm the status of my network, please? Please, 1 minute, please. Let me quickly find solution to that so that we can. Sorry, please. I'm trying to fix the network so that it can be clearer. Don't want to log out because of our time. All right, let us continue. Okay, it's okay, right? Return on the second. Look at it. I've explained it here now. You didn't read what I wrote here. You didn't read this bit. I've explained all those things here. I just used letter to represent that. I said where ERP result expected return on portfolio, RY is required return on original portfolio. I just use my Y to represent the original portfolio. I use Z to represent the required return on what? On the FCA stock. You can use letter of your choice. So let's go to Roman figure 2. Roman figure 2. Expected covariance of the government securities returns with the original portfolio. Now, what do we mean by covariance? Covariance means is the measure of what? Is the measure of the movement of two securities or two or more securities, let me put it that, two or more securities in a particular portfolio. The movement of the returns of two or more securities in a portfolio is what you call covariance. Now, covariance and correlation are similar, but to some extent they are what? They are different. Now, they are similar in the sense that the two of them are used to measure movement of securities. Investors are said to have diversified their what? Their position as an investor if they have invested in securities that are either zero correlated or what? Or negatively correlated. It therefore means that correlation measures what? The direction, okay? The direction of movement of securities in a portfolio. For instance, if I compute my correlation and I'm getting minus 1.2, it indicates that the investments whose correlation I have measured, they are what? Their return are not what? Are not moving in the same direction. Are we together? They are not moving in the same direction. Meaning that if the return, let me say asset A or stock A and stock B, if stock A and stock B returns are negatively correlated, what it means is that if return on asset A is increasing, the return on B will be what? Will be decreasing. If return on A is decreasing, return on B will be what? Will be increasing. Therefore, the investor will have said to have what? To have been fully diversified. Likewise, if the correlation is what? Is zero, it means they don't even move at all. They can both increase, they can what? Decrease, they can move in any direction. But if the returns are positively correlated, then there is problem. It means the investor has not diversified, because the interpretation of that positive correlation is that whatever is affecting one of the investment is equally affecting the other. So if the return of one is increasing, the return on the other will what? Also increase. If the return on one is decreasing, the return on the other is also what? It's also decreasing. So investor has not diversified if the correlation coefficient is positive. Now, correlation and covariance, like I said, they are what? They are similar. But the main difference is that for correlation will give you the degree of movement. Okay, the degree of movement will be stated by correlation. That is, correlation can tell you that, oh, look at it, oh, though this stock return, they are positively correlated, but the positivity is what? Is very small. It can be like 0.2, though they move together. Okay, they are positively correlated, but to a lesser degree. So correlation will give you the degree of movement. But for covariance will just tell you, oh, they move together or they do not move together. It does not give you the what? Degree of movement. But the two of them still measure what? The movement of stock in a portfolio. I believe we are together. Now, for you to measure covariance is measured as correlation between the investment multiplied by standard deviation of the investment. What do I mean? If I want to compute my covariance of two investments, let me say A and B, I will say covariance AB. I think I have the formula somewhere. I'll show you. Covariance AB will be measured as correlation between A and B multiplied by standard deviation of A multiplied by standard deviation of B. That will give you the covariance. Let me see. I want to see where I have the formula, so I will show you. Okay, I think it's A. 1 minute. I want to show you. Okay, it's not here. Should be 3. In that solution 3, okay, it should be here. It should be here. Okay. You can see this is what we call covariance. Okay, that's what we call covariance. Now, this covariance we are seeing here, the one I highlighted here, is measuring the relationship between stock Y and stock Z. That is what you see as what? Cov YZ, that is covariance YZ. Now, it's measured as what? Correlation of YZ multiplied by standard deviation of Y multiplied by standard deviation of Z. That is how to measure correlation. That is how to measure correlation. Okay. I now come here. Let me go to back to that tool now. To that tool now, we want to measure covariance of FCA stock with what? With the original portfolio. Now, if you look at the question, you see that the question already gave us what? Correlation. Look at it. If Abayomi said the FCA, he will invest the, okay, no, we have not gotten to that place. It's let me say where we are given that particular information on the correlation. On correlation. Okay, with the original portfolio, so look at it. With the original portfolio, it's given as what? Is 0.4. So correlation has already been given to us. These are correlation coefficients. The question is correlation between FCA stock and the original portfolio multiplied by standard deviation of the FCA stock multiplied by standard deviation of the original portfolio. I get my covariance. Do you understand now? As simple as that. That's why I said, even though the question seems technical, the principle is what? It's quite simple. The principle is quite simple. So look at what I did there. This is solution. Covariance YZ is equal to what? Is 0.4 times standard deviation of this. No. Have you got into this place? I think I've jumped to B. I've jumped to B. We are still in Roman figure 2. A. Okay. Times standard deviation of the original investment, the original portfolio, multiplied by standard deviation of the FCA stock. So that gives us what? 2.8. That is the covariance, okay? That is the covariance of the two stock. Okay. Back to someone that asks me correlation coefficient. It's quite simple. Just go and make correlation the subject of XY will be what? Will be covariance YZ over what? Over standard deviation of Y multiplied by standard deviation of what? Of Z. Just make this the subject of the formula. Okay? Just make it the subject of the formula. I believe that is clear. Okay, that is B. Then let's come to C. C says, if Abayomi take standard deviation of his new portfolio that include the FCA stock. Now look at what the question asks us to compute now. We want to compute expected standard deviation of what? We want to compute standard deviation of the portfolio. And I've told you earlier, if you could remember, that standard deviation measure what? Measure the risk of that what? Of that portfolio. And it's computed. If you want to compute the standard deviation of the portfolio, is computed using the snake formula. I mean, you use the snake formula for it. Now, I've given you the snake formula earlier. Now let's see, that's what I'm going to use to compute our expected standard deviation of this new portfolio. What is the new portfolio we are talking about? The new portfolio of what? That comprises the original portfolio plus the FCA stock, okay? Now, this is the formula here. Standard deviation of the portfolio, okay? We set it as the risk of the portfolio is what? Standard deviation of y square. Next, it simply means that variance of y. That is simple meaning. If they give you variance, you don't need to square it again. Just put it there. But if they give you standard deviation, you need to square it, because standard deviation is square root of variance. The square of standard deviation is variance, okay? So I will say multiply by the weight of what? Please, the weight of what? Y, which I'm representing here with what? With x. Then plus standard deviation of x of z square, which is written as what? As variance of z multiplied by 1 minus x. X is what? Weight of y, abi? So 1 minus x represents weight of z. Then you square it of weight of y multiplied by weight of z. That's what x times 1 minus x. X is weight of y, 1 minus x is weight of z. Please, you are not squaring this. This is the only one you are squaring. You are not squaring this. Then times covariance yz. I've already shown you how to compute covariance, Abi, and we have already computed covariance for this. So I will simply go and bring the return on the original portfolio multiplied by the weight of the original portfolio square. Sorry, standard deviation of returns, please. Standard deviation square plus times weight plus the weight of FCA stock times the standard deviation of the FCA stock plus 2 times weight of the original portfolio times what? Weight of FCA stock times the covariance. You just have to sit down and make sure you understand this formula. It's not, let me see. No. It's not part of what we give to you. It's not given, it will not be given to you in the exam. So you have to know it. So when we evaluate, we have 5.65 times 0.19 plus 8.7 times 0.31 plus 2 times 0.44 times 0.56 times 2.8. So when you evaluate everything, you have square root of 5.1. And square root of 5.1 is what gave me that 2.26. That is what? That is the standard deviation of the portfolio. That is the standard deviation of the portfolio. Okay, done. On his new portfolio, this says if Abayomi sells the FCA stock, he will invest the proceeds in risk-free government security. What is the value of the FCA stock? 1,400. Okay, we are assuming he will sell it for 1,400 and he will spend the exact amount to buy the government security. So the government security is still having 1,400 as the FCA stock. Okay, so if he sells the FCA stock, he will invest the proceeds in risk-free government security, yielding what? 0.34% monthly. Assuming Abayomi sells the FCA stock and replaces it with the government security, calculate expected return on his new portfolio that include the government security. Okay, so let's go how to compute expected return. I don't think that should be a problem. Okay, The weight still remains the same. The only thing you are going to change is what? Is now the required return. The required return on the government security. The weight still remains the same as the FCA stock. You understand? So it's the return that will now change. Now, when you evaluate that, you have 48%. You have 48%, 0.48% rather. It's 0.48%. What can you notice? You see that the expected return on the portfolio has dropped compared to when we have FCA stock in that what? In that portfolio. The reason being that the risk-free rate, the rate on risk-free security is what? Is small compared to a risky security. So the return on the FCA stock is higher than the return on this government security. Hence, the return on the portfolio as a whole is going to what? Is going to drop. I believe that is clear. Okay. Now, 2, we want to calculate the expected covariance of the government security with the original portfolio. Now, may I tell you that the correlation still remains what? Is 0.4, okay, times what? Times the standard deviation of what? Standard deviation of the original portfolio. Then times, how do I get this 0? That is the question you should ask me. Now, because I am dealing with what? I am dealing with risk-free investment. I am dealing with risk-free investment. Am I going to have standard deviation? No, because standard deviation is a measure of risk. Standard deviation is a measure of risk. And since I am now dealing with a risk-free investment, then the beta is 0. Do you understand? The beta is 0. So when you multiply this, you see that the covariance is also what? The covariance is also 0 because they do not move together. This is risk-free, the other one is risky. So this one is not having risky, it's not having risk at all. So they are not what? They are not moving in any direction. They are not moving in any direction. Are we together? That is you can see that in this particular question here, the question will not tell you, the question will not let you know that, oh, the risk of a risk-free rate investment is 0. No, to know that, oh, since this investment is riskless, it's not risky, then the standard deviation should be 0. Okay, but what would have been your problem is, I know some students, if they had come across this question in the exam and they've not come across a similar question before, they will be trying to compute the standard deviation on the risk-free rate, or they will be looking at the question as being incorrect because they want to see the standard deviation of the risk of the government security at all costs, not forgetting that the government security is what? Is risk-free, and all risk-free investment we have a what? A standard deviation of what? A standard deviation of 0. Okay, so that's that about 2, B Roman figure 2. What about Roman figure 3? Expected standard deviation of his new portfolio that include the government security. Consider, we want to calculate the risk of the portfolio that includes the what? The government security, not FCA stock now. You know that the standard deviation of the FCA stock is given earlier, and we are able to compute the covariance of the FCA stock with the original portfolio, isn't it? But here, because the government security and the original portfolio do not covary, so the covariance is 0. That is why you see we are having what? We are having 0 here. This is the return on the the standard deviation on the original portfolio. I square it, the weight on of the original portfolio the standard deviation, sorry, what do they call it? Oh, excuse me. This oh, sorry. That solution is wrong, please. That solution is wrong. Let me tell you what to do, please. That solution is wrong. It's not supposed to be 0.34. Here is supposed to be 0. Okay? The reason being that this is of that. Now, for the government security, there cannot be what? There cannot be standard deviation. So when you have that 0.34, what should be there is actually what? Should actually be 0. Okay, and if 0 is here, this times this will be 0. I mean, the whole of this place should be what? The whole of that place should be 0. This place here, the whole of this place should be 0, because 0 times the bracket is what? It's going to be 0. Now, if that is the case, all this one also must also be 0, because everything is being multiplied by what? By 0. Can you see that? So if you are dealing with, if you have a risk-free investment in your portfolio, the whole of this side is going to be 0. And for that particular risk-free investment, this side will also be 0. So I'm mistaking that the return for what? For the beta, for the standard deviation. Please, it's not going to work that way. So here should be 0. This place should also be 0. So what we are going to evaluate is what? It's just this one square times what? Is 0.45. So obviously, that's going to be this one should be excluded. Okay, that should be excluded. So what I should have is what? Is square root of 1.02. When you multiply this one by 0.19, you should get 1.02. So take the square root of 1.02. That's my calculator. 1 minute, please. Let me point my calculator so that I will see that. Square root of 1.02 should give me around 1.01 or so. Okay, 1.01. So that is how the standard deviation of that portfolio that include the government security should be computed. Okay, I believe that is clear. So this is not going to work. Use 1.02, this should be 1.01. Okay, the last part of the question, you should determine whether the beta. See, let me take your question. Oh, is it 1.07? Okay, if it is 1.07, fine. So we also explain whether the beta of his new portfolio that include the government security will be higher or lower than the beta of our original portfolio. Justify your answer with one reason. No calculation is required. Now, beta measures what? Systematic business risk. Abi, it measures systematic risk on an investment, isn't it? Okay, when you add an investment that is not having risk to your existing risky investment, what do you think will happen to the risk of the portfolio as a whole? The risk of the portfolio should go down because you have added an investment that is risk-free. It's just like weighted average. Okay, it's just like weighted average. So if you want to find the weighted average beta of your portfolio, and your portfolio include a risk-free investment, then the weighted average beta of that portfolio is expected to what? Is expected to drop. Okay, is expected to drop. Okay, and the reason is that beta factor for risk-free investment is what? Is 0. Okay, so it's not a story. Justify your reasoning by what? Just a statement. Now, this is the explanation. This is my statement. The beta of his investment that include the government stock will be lower compared to the original portfolio. This is because the beta factor measure risk, and since the government by reducing the beta of the, I believe that is clear. Okay, let me see your question in the next 1 minute before I go to question number. These are what nature of the questions you should expect in your exam. Okay, these are the form you should expect in the exam. Question. When it is 8:24, I will go straight to question number 4. We do have question, right? Okay, thank you. Okay. It means we are good to go. Let us now go straight to question number 4. Now look at question number 4. Question number 4, I think I pick it from, was it November or May? I can't actually remember. It should be May 2019. Yeah. It should be May 2019. It's May question 2019 ICANN exam. That is from where a typical, that's to tell you that what you're doing here are typical examination questions, okay? And I want you to get used to format that in which the exam might come, so that you're able to do something reasonable. Okay, let's take the question. The managers of a pension fund follow an active portfolio management strategy. They try to pursue shares and bonds that show a positive abnormal return, positive alpha factor in case of shares. The pension fund is required by law to hold at least 40% of its investments in bonds. 100 million is currently available for investment. 3 shares and 3 bonds are being considered for purchase. The required return on bonds may be measured using a model similar to the CAPM, capital asset pricing model, where beta is replaced by the relative duration of the individual bond, DY, and bond market portfolio, DN, that is DI over DN. What is this question saying? Let me explain that paragraph. When you want to calculate required already, because to calculate required return, I've already told you, you are using a formula, you must have a beta, isn't it? So if you are dealing with shares, for the shares, it's okay. You are using beta of share. That with bond. If you are dealing with bond, you might not get better. Now, for you to measure beta, you measure beta with reference to what? To the bond duration. You measure it to the bond duration. With reference to the bond duration, please. You may need to go and study the bond duration, okay? Because time will not permit us to what? To treat that topic. Go and study it. If you have questions, if you have go and study bond. Go and study bond. Very, very important, please. Okay, so the question is telling us that for the purpose of bond, we should measure the bond, the beta, making reference to what? The bond duration and the duration of the bond market. That is what is given as what? DI over DM. Don't forget, I said for you to measure better for investment is what? Standard deviation of what? Standard deviation of the market of the investment over standard deviation of the market multiplied by correlation coefficient if it is given. Isn't it? So when we are dealing with bond, is measure using what? The duration of the bond over the duration of the bond market. That is what the paragraph is explaining to you. Now, we have this information here. Let's go to the information we are given in this question. We have a expected return, we have standard deviation, we have correlation coefficient of return with the market. Okay, now for equity market, I think we are dealing with shares. APSA, this is the expected return on the shares of APSA. 11% is 25, and the standard deviation with the market is 0.76. For BPSC, 9.5 expected return, 18 standard deviation is 0.54 coefficient of correlation with what? With the market. Now, for CPSC, we have 30.5% expected return, 35% standard deviation, and 0.63 correlation coefficient with the market. Okay, what about for the bond? For the bond together, I'm not going to give you the solution. Just like that. We have to make it clear because I've give you everything that you should be able to solve this question without my guidance. Yes, the question 2 and 3 that we did, okay, without me guiding you. So we are going to make it okay. Thank you, my host. Now, I was saying that the previous question we have solved is enough to guide you to solving this question. So I'm going to ask you a series of questions here. Don't look at the solution. Help yourself. Don't look at the solution. Yes, don't look at it. Let us do it together. Okay, for the bond, we have the bond market. This is the duration of the bond market. Okay. This is the redemption yield. The redemption yield represents the return. Don't forget. Redemption yield, yield to maturity. Yield to maturity, redemption yield. Don't forget. We treated this our cost of capital. Okay. So federal government, this is the duration, this is the coupon, this is the redemption yield. For DPSC and for EPSC, we have them given as well. Okay. Note, assume risk-free rate of 4% per year. Evaluate whether or not any of the shares or bond is expected to offer a positive abnormal return. Are you telling me you can do this? For what we do, or for what we did under question 2? There with what? With the expected return. Now, in question 2, we were given beta free of charge. We need to compute that beta. How do you compute beta? Let's go to the question and see. If I want to compute my beta, I have my standard deviation of what? Standard deviation of the security. I have the standard deviation of the market. So what will I do? I will say standard deviation of APSC stock, which is 25, okay, multiplied by the correlation coefficient of APSC stock with the market. Look at it. If you rule this one, you can see it. 0.76. So I will have standard deviation of APSC stock multiplied by the correlation coefficient with the market all over what? Standard deviation of the market. So hence, I have 25 times 0.76 over 15. I get the beta. Do the same thing to this. 18 times 0.54 divided by 15. This 35 times 0.63 divided by 15. That will give you the beta. So after getting the beta, go and use it to compute your what? To compute your required return. Your required return will not be what? Risk-free rate. We are given the risk-free rate to be 4%. Okay, plus beta into bracket. What is the market return? Look at the market return. Equity market. This is the return, expected return. Equity market return minus risk-free rate. That's all. You get the what? Required return. Then compare it with what? With all this expected return to get which of the stock is expected to offer a positive abnormal return. I've already told you what positive alpha is. A positive alpha is what? Is indicative that you should what? You should buy a bit. So that is offering positive abnormal return. That's what it means. When you have your alpha value positive, that security having that alpha is having positive abnormal return. Okay, we are computing our beta. These are beta. To do that already. Okay, thank you, my host. All right, we're computing beta. Sorry for the break, please. So sorry. let's hasten up a bit because of our time. Now, we want to compute better of these company shares, Abby. Now, look at it. Correlation coefficient, the formula I gave you earlier. Correlation coefficient times what? Investment standard deviation over what? Market standard deviation. Now, if correlation coefficient is not given to you, you don't have to go and use it. Just pick investment standard deviation over market standard deviation. But if correlation is given to you, use correlation. Okay. If correlation is not given and you are given variance of investment variance of the market, use variance. So these are the various ways of what? Of computing your beta. Okay, of computing your beta. So for A, we have this, for B, and for C. Okay, now for the required return now, we have our company APSC, BPSC, PSC. This is our expected return. These are the required return. Can you see? Risk-free rate plus beta into bracket minus expected return, market return minus risk-free rate. So these are the respective required return. Now compare it. Our alpha value is computed as what? Expected return minus required return. So here we have minus 1.26, 1.28, and what? Minus 0.06. So which of them is offering positive abnormal return? Can you answer that question? Which of these three companies' stock is offering positive abnormal return? Which of them? Which of them? Oh yeah, tell me. Which of them? BPSC. So BPSC stock is offering positive abnormal return. Okay. Now you also go and do same for bond. Okay. Do it for bond. For bond, we are computing the beta with respect to what? To duration. So pick the duration of the government stock divided by the duration of the market. We have 0.2. Nothing like correlation. Then pick the duration of DPSC divided by the market what? Duration, bond market duration. We have 1.15. Do the same thing to E. We have 1.89. So go and compute the required return. The same thing we did to the shares. Okay, these are the expected return. These are the required return. The only thing that changes the result is better. Okay, is better. The market return remains, the risk-free rate remains. So what's our alpha? 1.26, 1.28, and what? Am I doing the same? No, this is not correct. Oh, I simply replace this figure here. No. That's not correct. Yeah, it should be where you have that beta, it should be 0.2, okay? It should be 0.2, 1.15, and what? And 1.9. For government, okay, let me go back to that question and show you. This is what you should have. Government, federal government, DPSC, and what? And EPSC. That is what you should compute. So I believe you should be able to do that. Okay. If you solve that, you should okay. The shares of BPSC and the federal government bond, okay. So the federal, if you follow what I just said, you will notice that the federal government bond, the alpha value should be positive. So it means that the shares of BPSC and the federal government bond offer a positive abnormal return. Okay, offer a positive abnormal return. That is A. Please correct that the required return for the bond. Can they correct that in your own note? Now, B, what is B asking us to do? Okay. B, the pension fund currently has the maximum permitted investment in share and wishes to continue this strategy. It has a market value of 1,000. Look at it. Let me explain that to you. And a beta of 0.62. What this question is saying is that the current portfolio of this company, of this pension fund, is what? Is having a market value of 1,000. And this is the beta. Okay? Now, the pension fund has this amount to invest. Let's see, I think they gave us 100 million, right? It has 100 million to invest. And the pension fund is required by law to what? To hold at least 40% of investment in what? In bond. Can you see that? So 40% of 100 in bond, 60% of 100 in what? In shares. It means that those stock that offer positive abnormal return, we have to buy them. These are the stock we can buy. I believe you can remember that strategy. I said stock that have positive alpha, meaning that what? They are what? They are undervalued. What do you do? You buy them. So it means we can buy the shares of BPSC and we can buy the federal government what? The federal government bond. Hence, I will spend 40% on the federal government bond. I will spend 60% on the stock of BPSC. Now, it's either you find the absolute amount, that is 100%, 40% of this, or you just go by the percentage given to you. Whichever approach you have taken, you should be what? You should be fine. So that is what I'm going to do. I'm going to spend this amount now on the stock of BPSC and the federal government stock. And of course, the portfolio, the pension fund company already has what? A market value of 100. Its current investment is already 100 and the beta is 0.62. So the first thing you are going to do for you to get, what's the question asks you to do? Sorry. B. Now calculate the required return from the pension fund if any shares and bond with positive and normal return are purchased, isn't it? State clearly any assumption that you make. Now, look at this. Sorry. Calculate the required return from the pension fund. From the pension fund is the required return on the portfolio of the pension fund. And you know how to compute your required return. Now, we are no longer dealing with required return on investment. We are dealing with required return on the what? On the portfolio as a whole. So I need the beta of the portfolio. Do you understand? I need the beta of the portfolio. Okay, the beta of the portfolio should be computed as the weighted average beta. That is what you have there, weighted average beta. And the weighting factor should be what the market. Look at it. The existing portfolio of the pension fund is 1,000 by market value. And the beta is what? Is 0.62. Multiply 0.62 by 1,000. You have 620. That is the hash total. Now, for share of BPSC, the share we want to buy, how much do you want to spend? 60%. I told you, you can say 60 times 100, 60% of 100, which should be 100 million, which should be 60 million, no problem. You can equally go with what? With the ratio. 60% on B shares, 40% on federal government, no problem. See the same thing. So I'm using the ratio now. 60%, then the beta is what? Is 0.65. Abi, the beta of shares of BPS is what? 0.65. So I get the hash total here. Then for the federal government is 40%. Then times what? Beta of 0.2. We have what? We have 8. So our total, hash total here is 667. So for me to get the beta of the portfolio, it's going to be the hash total all over the total market value. As total over total market value. And that gave me what? 0.61. So I use that 0.61 to compute my required return on the portfolio. Now, hold on. I will now ask you, you see that the question asks you, state clearly any assumption that you have made in this question. Now look at the reason why the question states that. I want to compute required return on the portfolio as a whole. Now, I need market return, isn't it? Now the question is, which market return do I use? Do I use the market return of the shares or the market return of the bond? Consider that. That's why the question states that state clearly any assumption that you have made. Because without that assumption, you cannot go further. Because you will be confused. Which market return do I use? Is it that of the bond or is it that of the shares? Any one you have used is correct, but state your assumption. Use that of what? That of the shares. So I will now say assumption. It is assumed that on the shares, the market return on the portfolio of the pension fund Thank you, Miles. So I was giving you the assumption on the shares of 10.5. Ultimately, or is a representative market return on the portfolio of the pension fund. Are we together? So that is the assumption the question wants you to make. That's why they say state clearly any assumption that you have what? You have made. So I take my risk-free rate plus beta of the portfolio, can see, for the pension fund company, market return minus risk-free rate. I have 7.97%. You will see that this question is simple, but for you to solve it, you must understand the principle behind portfolio theory. All right, that is the end of our session 5. Thank God we are able to complete the session today. So I want to believe tomorrow we should be able to complete session 6, or if we're not able, we conclude the remaining part on Monday, then we go to edging. Okay, let me quickly take your question in the next 2 minutes, 2 to 3 minutes. In the next 2 to 3 minutes, let me take your question before we call it a day on this platform. Question, please. Ask your question. Ask your question. Ask your question. We don't have question? No question, right? Okay. Okay, that's not bad. That means we quite understood what we have done on this platform today, right? Yeah, don't forget the mock question you promised to send. Mock question. I didn't promise you more questions. It's FCA. It's FCA that will send you more questions, not me, okay? Not me in particular. I will only set the most question and send to FCA. Then management of FCA will send the mock question to you. Don't worry, okay? You will get it. You get the mock question. Which one is CML, Mr. Adams? Mr. Adam Yakubu. Which one is CMLO? Oh, okay. You mean capital market line. How can you what? How can we determine it? You construct it from the return on the what? On the security. Okay. But what you stated is capital market line, not security market line, Abby. You mean the capital market line. Okay. You can chat me up for that because of time. Okay. Chat me up for that. I'll explain to you. You know, I wasn't able to cover all those security market lines, capital market line because of our time, because of what we need to cover. Okay. Just chat me up. I'll give you a clue as to what to do. All right. Thank you. Thank you so much for staying with me for today. We are going to meet tomorrow by the special grace of God, the same time, 7 to 9, for us to continue with option pricing theory. Until then, do have a blissful night rest. Bye. All right, my host.
All right, thank you very much, sir.
Welcome, sir.